Hi, morning. Great to have you on ET now. Prashant, I remember, just everyone is now talking about whether you need to make that tactical move and go overexposed to consumption. The last time when the consumer cycle really saw its heydays was, I think, when you were in HDFC, right? Back in the day, when you did identify some names like Page. Do you think that cycle is back now? Are we on the onset of it with all that's happening domestically with regards to the government push?
Good morning to you and to all your viewers. I think that's a tough one to call. Certainly if markets remain weak, there could be some outperformance there. But I think the multiples to my mind are quite rich in the consumer staples and the consumer white goods, brown goods, home improvement, etc. I think there is multiples are somewhat reasonable in the auto OEMs space. I think it remains to be seen whether these rate cuts that are anticipated, they improve volume growth or they simply lead to consumers upgrading in the same vehicles. I would say, there is no clear direction to my mind in this space, right?
That seems to be the case. And I think, Prashant, the other debate also is whether more hands in the consumers is going to really make them buy more staples, or are they really just going to upgrade? Or, like you said, whether that's going to go into white goods or eventually two-wheelers.
See, I think we have to be cognizant that India is a 4 trillion economy, and if you give a benefit of $10 billion or thereabouts, it is material for the marginal consumer. But ultimately, I don't think it can fundamentally alter medium to long-term growth prospects. Yes, it can provide a maybe short-term blip upwards. I think ultimately the growth in consumption has to be linked closely to at what level the economy and the incomes are growing. And what has happened over the last 5-6 years, we have discussed this a number of times. The leverage of households has gone up very sharply because post-COVID, one of the adoption of digital loans and EMI-based purchases has been extremely rapid. And that is what led to some preponement, if you may say so, of demand. And now we are seeing that there are challenges on the asset quality in some segments of the lenders. So I think I would say India is on a steady growth path. But while what the government is likely to do is a step in the right direction, but it would be too aggressive to my mind to say that this can fundamentally alter the growth trajectory or the outcome of these stocks over the medium term.
So, Prashant, what is the market pricing in right now around these 24,500 to 25,000 levels? Is it more hope and anticipation of what GST rationalization could do, or is it more disappointment of what this additional 25% tariff is doing?
I think the markets have been broadly range bound for last 18 months or so. If you see between 22,000 to 26,000, right now we are somewhere in the middle. I think this has been a reasonable time correction of last year or 15 months. I think in about 6 months time, 3 to 6 months time, markets will start trading on calendar 27 or fiscal 28 earnings. And I think based on that, the large caps to my mind are looking reasonably valued. The risk reward is reasonable. So I would say the next 3-6 months offer a good window to medium to long-term investors to invest. But I would prefer the large caps. But longer term, you have to be realistic about the impact of lower inflation on nominal returns. So if your inflation is running around 4%, if your nominal GDP is growing around 10-11%, longer term, I don't think markets can outperform that meaningfully. So if your cost of capital is low, if you are getting a home loan at 7.5%, if your inflation is low, if your dollar 1 year premium is down to 2%, I think we have to be mindful of having right expectations. But of course, the wealth creation or the increase in purchasing power should continue at the same rate around 6-7%, which is equal to the real growth of India. And that indeed has been the case for last so many decades in India.
Oh, yeah, absolutely. In the long term, it all looks good, and so does it in retrospect. But in the very near term, Prashant, you think there are crucial decisions like your sector allocation decision that needs to be made? How long does it take for India and US to resolve the tariff situation? What the implications on the GDP is going to be, the rate rationalization, etc. Do you try and make those tactical moves from out of capex into consumption, or you don't do that?
You speak to policymakers more than I do, so you would have a better chance of guessing that outcome. But I do think that India and US share there are a lot of commonalities between these two great countries. And I think we should be able to resolve this, not in the too distant future, but that's a hope. The good thing is that the impact of these tariffs in India will be very, very, if I may say, in small segments of the economy. Our export of goods to US is just about 2% of our GDP. And even there, if you see the value addition in many categories, like we are exporting mobile phones or we are exporting finished, polished diamonds or even some gasoline maybe, I think the value addition is even sharply lower. So maybe 0.5% of GDP could get impacted. I don't think this is going to meaningfully impact India, though of course these specific industries or people employed in these industries, there could be some challenges for them. The expectation, the hope is that this does not spill over to services, which I don't think is likely. But India is actually a large services exporter and not a goods exporter to the US. So to that extent, the impact of what is going on is likely to be minimal on India's economy. I think the issue with the markets is that the supply of stock is just too large. And I mean, we see so many blocks, QIPs, NFOs, promoter sell downs, PE sell downs. It is just quite large. And that is what is holding these markets in a range bound way. I don't think that is negative, because the amount of money that is also coming into the markets, had the supply not been there, these markets could have become really expensive, which is not good for long-term investors. So I think net, India is on a very good wicket. Our markets are, if you observe, the volatility of Indian markets has collapsed. I mean, if you look at last 25 years, volatility is down almost 70%. And that is because the power has shifted from the foreign institutional investors to the domestic investors, which is a very welcome development. So I think short-term moves apart, I would remain optimistic on India, but we have to be realistic in our return expectations. And I think there are pockets of excess in these markets as well, but they are mostly in the small mid cap space, which is where I would be cautious. Yes.
Prashant, sectorally, what would your decision be right now? I know we've spoken about consumption, but consumption versus capex, do you add more to consumption right now, wean off a little bit from capex, or do you think that one needs to have a balance of both in one's portfolio?
I think, see, if you look at the dispersion in valuations in these markets, it is one of the lowest dispersions that we are experiencing right now. And the dispersion peaked post-COVID, when certain pockets of the market were deeply undervalued and some were quite expensive. But at both the ends, the excesses have moderated. And a good example of that would be, let's say, the retail-focused banks way back then were trading around 5 times price to book. And the corporate assets focused banks were trading, let's say, between 0.25 to 1 time price to book. Now both have converged somewhere between 1 to 2 times. And similar things have happened across sectors. So these are markets where dispersion in valuations is extremely low. And in our judgment, in my opinion, it makes sense to remain effectively diversified in these markets. Having said that, I think the capital goods space did become very expensive in the past, and I think we have discussed this at some point of time, that while the growth should be better than consumption, the multiples were just too rich. So I think I would be cautious on the capital goods space, and I would be probably close to neutral or something like that on consumer space, because the good thing in consumer space is that this sector displays more of time correction and less of volatility, especially the consumer staples space. And it has underperformed for a while, and there are some tailwinds. So it could lead to some very near-term marginal outperformance. But longer term, I think still valuations remain above comfort levels in that space.
And then, Prashant, there is this entire new age quasi-consumption play also, right? Wherein the valuations are pretty frothy, but those stocks are definitely not coming down. And I think the debate is also whether you pay 40 times for kind of now leadership that you are seeing within that segment, everything from food aggregators, etc., or do you actually pay lesser for the traditional staples? But then again, question mark is on growth.
I think you are right that the new age companies should deliver faster growth, but I don't think you are at a stage where you can that narrative is good enough to turn out for these stocks to turn out to as good investments, because the markets are pricing in fairly aggressive growth rates, and in some cases the sight of profits is still not in the near term, and we have seen some serious disappointments also as well in this space. So I think it would be inappropriate to club them all as new age companies. And I think this has got to be a very, very bottom-up individual stock-based view or investments that one is to make. At the same time, the traditional consumer staple companies are facing some moderation of their comparative positions or moats, because talent is now available even to smaller companies, to PE-funded companies. The media, it used to be few channels few years back which were very expensive. Most companies could not afford. Now social media is extremely important, and that is granular. So ability of smaller companies to engage with consumers has gone up. The consumer is a lot more experimental today than was the case 20, 30 years back. And finally, the distribution mode is also coming off as retail becomes, as organized retail steps in, as e-commerce steps in, and as India achieves better connectivity. So I think these are all the reasons why one should be cautious about the impact of these forces also on the traditional, very strong for now, consumer staple companies. And one final thing, we are also seeing space being ceded to private labels in some categories. Yes.
Absolutely. So Prashant, I know one shoe doesn't fit all, but if you were to make a portfolio or recommend exposure to the various sectors right now, you did touch upon banks, capex, and even consumption. But if someone had to put in fresh money to work right now, what should the exposure be to all sectors possibly that one can invest in?
So, I may sound too simplistic or unexciting, but I think in these markets, just buying Nifty or Nifty heavyweights would be a good strategy because I feel, I mean, I could be wrong completely. I feel the large caps will do significantly better. And I mean, if I have to pick sectors, I would still pick banks, life insurance, uh, maybe telecom, even software. I mean, if at some point of time growth improves, the risk reward could be quite favorable. Pharmaceuticals, automobiles, OEMs selectively. I think utilities, these are spaces which appear to be good to me.
And what within CapEx? Expensive defense or relatively cheaper power?
I think I would be still cautious on the capex theme because I think, see, this cycle is very different from the previous cycle. Many people like me have simply extrapolated the cycle of 2003 2008 directionally. I don't think that is right. There are very basic, very fundamental differences between the very high growth that these stocks or companies delivered and what is likely in this environment. So I would be, I mean, bottom up, yes, if there are many companies, one or two may appeal, but top down, I feel this sector is still quite expensive.
But that's the problem, right, Prashant? Hardly there are any bottom-up stories. It's a very well-discovered market in that sense.
So yes, you are right, and this is a phase of the market. And 5 years back, it was just the exact opposite. I'm sure many of us would remember that. Then you could buy companies at 3, 4, 5 Ps. And this is one phase of the market where deep value is not available in any meaningful pocket of the market. So as I said earlier, our return expectations have to be realistic. Uh, at the same time, I would not be pessimistic on these markets because Nifty has consolidated for a fairly long time. And as we get into fiscal 28 discounting, I think the risk reward will start looking quite reasonable. And let us not forget that we are still, I feel, in the early stages of the shift or of retail savings to equities. So I think that's a trend that should sustain for many, many years, decades. And therefore, whatever returns we make, it will be with much lower levels of volatility compared to the past.
Prashant, next 3 to 6 months, or even 8 for that matter, do you buy big or do you still sit on cash?
I think this is a market where we should try to hit our long-term asset allocation to equities in the next 3-6 months. So I don't think, see, equities are a long-term asset class, and no matter how hard we try, it is very tough to forecast short-term movements. But these are reasonable multiples. India's cost of capital is much lower than the past. So even if your multiples are 15-20% higher than longer-term averages, I think one can defend that these can be justified given the sharply lower cost of capital. India's macros are really strong. Our current account deficit is likely to stabilize around 0.5%. Now, when in the past have we seen that? Our external balance sheet on a flow basis is in fairly good balance. Last year, we saw hardly any net foreign FDI into the country. Foreigner portfolio managers, FIIs have been net sellers, yet you find you are comfortably placed. So I think both our current account deficit and fiscal deficit are in fairly healthy zones. The corporate leverage is probably at a 15-year low. Bank NPAs are extremely low. I think we are on a fairly good, strong wicket. It is just that the expectations from stock markets have to be realistic. I mean, just to put things in perspective, last 25 years, the Nifty or Sensex CAGR is about 12-13%. So we should not get impatient if markets have consolidated for 1 year. Ultimately, if the economy keeps on growing, equities will create wealth over time.
Absolutely, and patience is the strongest virtue of a good investor, so should keep it at that. But Prashant, thank you so much for your insights today. Great chatting with you.
No, pleasure. Thank you. Thank you. Bye.
Okay, that's Prashant Jain telling you to hunker down your expectations, be a little careful about SMIDs, invest largely in large caps, and yes, next 3 to 6 months.